Hello everyone. Okay. Thanks guys for joining. Thanks everyone for joining us in this episode of my webinar. All right. Okay, just a quick check for you from you guys. I'd like to know, find out if you all can hear me clearly. If you all can hear me clearly, please just put a one or yes, you can hear me clearly. Hello everyone. Thanks for joining. Thanks everyone for coming in. Wow. Can all of you hear me? Thank you, thank you. All right, great. Well, thanks, Luis. Thanks, Apinder. Thanks, Kalok. Thank you so much. Thanks, Gamil. Thanks. Okay. Can you all see me also in the video? All right. Can you hear me? Can you see me in the video? All right. Um, good, good. Because I can't see myself. Hold on, yeah. Okay, yep. Great, great. All right, thanks guys for coming. Wow, today's participation is quite good. All right, so before I start, okay, just to introduce myself, my name is Joe. I'm a dealer from CFD department in Poems. Okay, I believe most of you guys here have heard of Poems before because I mean, either you have used the account before, or maybe you come from you're maybe referred to from someone from the to join my webinar today. All right. So for a start, I'd just like to share with you guys lah. Okay. If you are new account opening, if you are going to open a new account today and you haven't opened an account with us before, okay, what I have actually is we have a welcome promotion, okay, of $50, okay, of stock coupons. If you fund in $3,000, okay, and hold it for 30 days. So if you open an account today, you within 14 days, you will fund in $3,000 and hold it for 30 days. We give you $50 stock worth of stock coupons and of $10 each. So 5 times 10. All right. And if you actually fund $10,000 and you hold it for another 30 days, all right, then you get $200 worth of stock coupons. So just to a quick one, just to share with you the link, account opening link here. If you guys are new to Poems and haven't opened a Poems account before, and what if today you have actually heard of my topic and then like what you really hear about what I'm sharing today, and you want to open a account just to actually buy uh to the stocks that I will be talking about today, okay, you can just go ahead and open an account. Okay. Another thing I'd like to share with you guys is okay, for today's webinar, okay, if let's say you guys got any questions, feel free to actually put it up in the chat box or the Q&A section. And at the end of the webinar, we'll have an actual Q&A session where you can ask me any questions, or you can also share your thoughts of what you think. Okay, of course, you can actually do it anytime you like, right? Okay, if you have a burning question you'd like to actually put in, but I will not reply immediately. So I would end off the webinar, I will just look through from the question one all the way down. So just feel free, put as many questions as possible. I'll try to answer every one of them. All right, because today's most of our webinars will come in the form of like community-based sort of sharing. So it's not just me actually just sharing my ideas. I would like you guys to actually also share your ideas with me, and we can just have a discussion. All right, I believe some of you guys here are maybe more experienced and already even in the business, and you guys actually have something to share, okay, with the community. Feel free to do so. We would like to hear from you as well. Okay. So before we start, okay, I'd just like to share, okay, I believe anyway, since we're talking about the stock markets, okay, today's topic also will be the stock market, will be on the stock market, but just based on Singapore real estate, okay, which is called REITs, okay. So of course, you guys have actually heard that the recent news, okay, that US is actually in war with Iran. So markets are really very volatile, okay, because markets are volatile. Okay, oil prices and gold prices have come up, all right. So I believe now you all will think that, hey, maybe oil prices and gold now very safe, very defensive, not safe now because wartime, people would like to rush into something that feels safer, okay, feels defensive. So they will go into gold, and then like we said, oh, because oil supply will be controlled very much by the Middle East. So maybe some of you also may go into oil. But why don't you consider this? Maybe real estate in Singapore also a good thing. Okay. So that's why today my topic I'll be sharing with you about the real estate in Singapore. Why is real estate actually a premium? Consider a premium, okay, asset. maybe for foreign investors as well. Okay, not only to us Singaporeans. All right. So the futures is actually now up. I see what I'm seeing here is up 0.76% in the US for the S&P 500. This primarily because I think today Donald Trump is going to actually speak to say that he will actually leave NATO. So I'm not sure if he were to leave NATO and then say that the war will end in 1 or 2 weeks' time. Is this actually even realistic or not? Okay, I'm not sure lah. Okay, uh, I don't think it's so easy. Okay, I don't think it's that easy. The war will still continue. Okay, because if US actually were the one to spur this with Israel, spur the war on with Israel. All right. Now, I believe they realize that now they actually control the oil supply. The Middle East people. I mean, Iran is actually controlling the oil supply. So this will actually affect a global supply in oil. So I believe if you guys actually know, Philippines also now is in a state of emergency because their oil supplies are low lah. All right. So without further ado, okay, I'll start off the webinar. Okay, let's take a look at what we're going to talk about today. So before I start, this video is actually more for educational purpose only. Okay, I do not want to actually do a call or buy or sell call on any of the stocks I recommend today. Okay, so okay, before I start, we have all our participants here. Okay, I'm not sure if you guys actually have come to my webinar before. Okay, but I believe you guys would like to you guys actually sign up for this webinar because you want to actually find out about property. Okay, property, real estate in Singapore. How many of you guys here? Let's put a show of hands. Okay, you give me a one. Okay, if you guys actually come here because you want to buy a new property this year, a real physical condo. Okay, put a one if you want to actually looking at buying a condo, or zero because you want to just come and listen only. How many of you looking at property? Come? Oh, zero. Okay. Any of you guys looking at buying an actual property in Singapore? Wow. Thanks, Catherine. Thanks, Becky. Thanks, Grace. Everybody zero. That means oh, thank you, thanks. Okay. Thanks, Gamil. Gamamel. Okay, yes, I see that many of you guys here actually come here maybe not for property. Okay, more for REITs. Okay, that's good. Thanks, Vincent. Okay, one thing is just to let you know that currently what I've been seeing because when I actually prepare this webinar for you guys, what I've been seeing is that since 2025 when I actually studied the market, residential property actually has been very strong. Okay, especially 2025. All right, like you see here, if you haven't heard of this new condo project in Tampines, okay, which is called the Pinery, okay, already 90% sold, okay, ever since their launch 2 weeks ago. Okay, it's not cheap, okay. This condo when they actually built it in Tampines, Tampines is like a far away from the city, right? And it's really not cheap. Prices are actually have hit close to near city fringe sort of pricing. All right, like you can see, it starts from 1.498 million for just maybe a studio apartment. Okay, so I believe because of this hype, okay, you can see that people, all these influencers or KOLs. How many of you have known this guy or seen this guy before on YouTube? Okay, he's been actually, the good thing about him is that he talks a lot about the bad and good, the pros and cons of each individual, different properties. All right, so not all properties in Singapore actually make money. Just to let you know first. Okay, so this guy, his name is called Eric Chew. Okay, pretty funny guy lah. Okay, I tend to like to watch his YouTube videos. Okay, quite entertaining. But in the midst of it, he actually does share a lot about the good and bad about certain projects in Singapore. Okay, but again, okay, he is actually quite, to me, after I watched a lot of his videos, I believe he is also quite biased in terms of the property market in Singapore. He frames it in a way that buying a property in Singapore, just buy and flip, very easy to make money. You want to make $1 million within 5 years, already you can achieve it. Okay, so 5 to 10 years, I mean, you flip 2 times, you already make $1 million, something like that. But is this really true? Okay, so I'm here to actually break down the numbers for you in a non-biased way. Okay, so listen on. Okay, so feel free to actually ask any questions along the way. Okay, as I mentioned again in the chat box. All right. So, wait, my mouse not, sorry, eh? Yeah, I can't seem to, hold on guys, can't seem to move to the next slide. Ooh, wait, hmm? What is going on here? Put next to that. Okay. I just click next to that. All right. So Singapore's property market has earned its gold mine reputation. Okay. Not through explosive volatile gains, but through a rare combination of extreme stability, scarcity, and strategic governance. All right. That's why Singapore property is actually known to be very premium. Okay. It's a premium asset lah. Okay, it's considered a premium asset class in Singapore. Okay, because why? It's Singapore land is scarce. That's one reason lah. All right. So the next one is in the climate of in the global climate of actually geopolitical tension. Singapore has also now built itself into something people call the Switzerland of Asia. All right. A lot of in case you guys don't know, a lot of investments from Middle East. Okay, not investments, funds from Middle East actually coming into Singapore, especially Dubai. Okay, the rich in Dubai actually now parks their money in Singapore because of the war lah. All right. So for the wealthy, owning a brick and mortar property in Singapore is like a high yield savings account. Okay, the rock solid rule of law, okay, and the clear property rights ensure that assets are protected from arbitrary seizure or sudden policy shifts. Okay, that is found in more volatile emerging markets. Okay, so the Singapore dollar is also historically very strong. Okay, and because it's managed by against a basket of currencies, acting as a natural hedge for international investors looking to preserve the purchasing power of their wealth. So if you all know Singapore, actually there's inflation still, but inflation is low lah. Okay, because the Singapore government manages the Sing dollar very well. Okay, so another thing also, why Singapore property is so scarce, like you guys need to know, is because Singapore roughly has 735 square kilometers of land. Okay, and this is actually very scarce. Okay, and Singapore population in year 2000 is actually 4 million, but today it's grown up to 6 million. Okay, due to an influx of foreign talent. And then we believe that Singapore, I mean, based on analysts' estimates, Singapore population is known to actually grow to 7 million by 2030. So now 6 million. By 2030, we're expecting 7 million people in Singapore, living in Singapore. So currently, to date, from 2000 until today, 2026, Singapore's population has grown 1.5 times already. With a land size of just 735 kilometers square, you just imagine how many houses they need to build for new residents coming into Singapore. And I believe now the government is also actually issuing a lot of PR, okay, or new citizenship to new Singaporeans. Okay, so this will actually boost the housing estate, the house prices as well as the real estate prices in Singapore, including rental. Okay. So because of land scarcity and growing population, the demand for housing could continue to be strong and could, like I said, drive up property and rental prices. So the Singapore government knows this, okay, and then because they know this, they tightly manages their supply and demand by implementing various regulations to prevent this style of supply gluts and bubbles that have crashed property markets in cities like Dubai or China. Okay, these regulations include the ABSD, or we call it the additional buyer stamp duty. Okay, so you see that for the ABSD rates, for Singaporean, okay, it's for the first property is 4%. Okay, and then for the second property, you have to pay an additional 20%, so that will add up to 24%. For PR, it's 5%, and for the second property is 30%. For foreigner, you see that the huge difference there, 60%, even for your first property. And then for entity, 65%. Okay, so this ABSD ensures that property owners only purchase a home in Singapore for their own stay and discourages buying of multiple properties for investment purposes. Such regulations like the ABSD allow for Singapore real estate to grow sustainably. Another regulation that is implemented by the Singapore government is the changes in loan to valuation limits offered by banks. So the loan to valuation for both private and government housing had been lowered from 80% to 75%, making it harder for a new homeowner to purchase a new property beyond their means. So this is the purpose. Despite having attractive rental yields and home loan rates that sit at a long-term 10-year average of around 2.5% per annum, in Singapore, it will be harder for any property speculator with little cash to speculate in the property market because of this the LTV limits, okay, or the loan to valuation limits. So I'll give you an example. A new $1 million property would require at least $250,000 in down payment and an additional 30,000 in buyer stamp duty. So if you buy a first property, okay, you already need a down payment of 250,000. And then on top of this 250,000, you need another additional $30,000 in tax to pay taxes, to pay to the government taxes. So all this you will actually need upfront cash 280,000, whether in CPF or hard cold cash. Okay, this calculation assumes that you have got one property only. All right, now let's take a look at the same example if you have a second property. Okay, if you have a second property and the loan to valuation drops from 75% to now 50%. So you can now only borrow lesser from the bank. And then because you need to add buyer stamp duty and additional buyer stamp duty, okay, which is now 24%. So initially you just pay the 4%. Now, because of the second property, you need to pay a 24% on top of your down payment. Plus, because your loan to valuation is now 50%, all added in for $1 million property, you need to pay up to $730,000. So from 280,000 to $700,000 is just crazy, okay? Assuming that you're a Singaporean citizen only. All right, if you're PR, that's even worse. So because PR now you need to at least the ABS is now required at 60%. So you can just see the amount of cash you need to take out, okay, to buy a property in Singapore. So it's just really, really crazy if you want to actually own a property. So but this is actually a very good thing because the government by doing this will actually stabilize the property market going forward. So it will not have a huge, it will cool down property prices. All right, it will have a steady growth. Okay, but it will not actually crash the market in the sense that like sometimes you see in China, property markets have actually really crashed all the way down, and then it takes many, many years to recover. So the government knows this because Singapore land is scarce. Okay, so that's the purpose of having so much regulations in Singapore. So the government actually has really looked very, very far ahead. So I really actually admire the Singapore government for doing this, okay, to protect the property market here. So now that you know that the barriers to entry into buying a private property in Singapore for investment is so high, is there still demand? So now that you see already, the barrier to entry is so high, right? So much cash needed, is there still demand? Okay, now we'll use the data to determine the demand supply. Okay, let's look at some numbers. So this chart here, okay, the one on the top left, okay, shows the number of transactions for new sale, sub-sale, and resale. Private and public apartments are together from 2021 to 2026. Okay, you'll notice that both prices and transactions have climbed since 2021 and made a record of 57,000 units sold in 2025 alone. Okay, this is a 3% year-on-year growth over the past 5 years. Not too bad. Okay, average prices in 2025 alone, okay, 2025 alone grew 17% year-on-year, making 2025 a very bullish year for the residential property market. Okay, you can see that in 2026, prices indicate a decline of 7%. So you see a slight drop in 2026. However, this does not actually reflect a true view, as it is typical that transactions are usually slow during the start of the year. If we look at the monthly chart on the bottom right, so if you see the monthly chart on the bottom right, you can see that every start of the year, actually, prices come down. So property in the beginning of every, first quarter, it tend to be quite slow, and then you pick up maybe in the middle of the year. So from this data, you're able to see that the various regulations from the government did not actually dampen the demand. In fact, property prices, for the last 5 years, annualized, actually grow around 3%. Okay. So instead, regulations really did help smoothen the demand and supply gap, preventing potential bubbles. Now, let's dive deeper and take a look at the non-landed private property growth rates by the regions. Okay, from here you can see there's this CCR, RCR, and OCR. Let me explain. Okay, CCR, what does CCR represent? CCR actually represent the core central region. So where is core central region? Core central region is like, okay, Orchard, the CBD. Okay, all these are core central region. Okay, what is RCR? Okay, RCR represents the rest of central region. Where's the rest of central region? Can be like places like the city fringe. Also, we call it city fringe. They can be like Newton, again near Orchard, Newton, Queenstown. All these are the RCR or the city fringe. And OCR represents the outside of city fringe. That means the neighborhoods outside. Okay, more like the places like maybe Tampines, okay, Changi, okay, and places like Woodlands, okay, Yishun, okay, this is of course in the north area, and then you can be like Punggol. All these are OCR. We consider this OCR. Okay, so the Singapore, we actually map our properties regions this way. Okay, so what we found that okay, what are the returns like, okay, for each individual region? Okay, so we found that the annualized returns for each of the three regions, the core, the rest of the core central of city fringe, or the OCR, were 3.73% for the core, okay, and 6.73 for the city fringe, and 6.81% for the outside city fringe, which is the neighborhood areas. Okay, so these are the annualized growth rates: 3.73, 6.73, and 6.81 respectively. So you notice something here. Okay, you notice that outside city fringe has actually grown quite a bit, Okay, outside city fringe and the rest of the outside city fringe, the core region and the city fringe, both of them actually grew by 6.73 and 6.81%, which is quite close. Okay, the only thing that is actually down, didn't grow so much, not down, didn't grow so much, is the core central region. So a lot of people will think that, wow, actually people stay in Orchard very rich. Rich people can actually make a lot of money. You buy Orchard you buy near MBS near Marina Bay Sands sure make a lot of money. Can see the fireworks every time sure make a lot of money. Not true. So the ones that actually really make the most, if you actually buy a physical property, is the OCR, means outside core region. Okay, outside core region, like most of the neighborhood areas in Singapore. And then, of course, selected neighborhoods, I'm calling, not all, okay, selected neighborhoods. And the city fringe areas, like, like earlier I mentioned, like maybe Queenstown or Newton, for example. Okay. So do know that all these returns that I showed earlier here, okay, they are gross returns. They are just gross returns and does not include any costs associated with these properties, such as interest payments, taxes, and maintenance costs. So all these you see are just gross. Okay, now let's look at the rental yields for these different areas. Okay, the rental yields for non-landed private properties in Singapore, okay, for the core central region, the range is from 2.5 to 3.5%. All right, while the city fringe area, or the RCR, okay, range from 3.5 to 4%, and the OCR, which is the outside central region, is the highest at 4 to 6%. Okay, but do note that these are gross rental yields only and do not include fees like agent fees to rent out your units and the taxes on rental income. Therefore, you need to less out all of these costs to manage the property, and the net returns for your investment property are just on, if let's say I take out everything, all these fees, okay, the net returns on your investment property averages just to 3% or less per year, okay, due to the various costs associated to manage your property. So just take note, all these are just gross returns only. It's not the actual, yields or returns that you see, mostly on, when you look at Property Guru, for example, or you look at newspapers, people say, oh, the rental yields have gone up. All these are actually, if you just believe what the headlines say, it's not true. Okay, there are a lot of costs involved in this. So if you minus out all these costs, the returns will actually just come down. Okay, so let's break it down. All right. What are the typical costs of managing an investment property in Singapore, or brick and mortar property? Means you buy a condo. What are the typical costs? Okay, they are the upfront ABSD that I mentioned to you guys earlier, which is the additional buyer stamp duty tax, okay, at 20%. Okay, which is you can go up to 200,000 for $1 million property. And then the BSD, okay, typically 4%. You can see the cost there as well. If let's say you buy a $1 million property, okay, and if this assumes that you're Singaporean only, and then of course there are also lawyer fees when you actually buy that property. You need to pay lawyer fees, typically $2,500 to $3,000. That brings the total upfront to already 227,000. Okay, like I mentioned earlier, in the earlier slide. And what are the ongoing costs? Okay, this one I didn't mention yet. Let me explain to you now. The maintenance fees. Okay, if let's say you want to deduct rental and you need to use all this already ongoing. If let's say you want to rent out this unit one, okay, you have to consider all this the maintenance. Okay, so maintenance should be typically in Singapore is $200 to $600 per month if you buy a condo. Okay, and then the property tax will be this is actually progressive. Okay, so it's taxed at tiers, progressive tiers. It's from 12% to 36%. So some properties can go up to $16,000 in property tax per year. Okay, so this is no joke, really no joke. If you all think the property very easy to manage, it's not true. It's very expensive, especially in Singapore. So property tax go up to 12 to 36%. Okay, and then you still need to tax on your income level because you take rental. So you, on top of paying the property tax, you still need to pay your income tax, which is also progressive. Okay, of course, there's tax deductible. You can use maybe your expenses from repairing your lights, fixing your toilet door, or repairing those fixed assets. Okay, that one you can claim. Okay, on top of that, you can also claim from insurance. You insure your property, you can claim from that as well. And also you can also claim from your we call it your interest. Okay, that means the monthly installments, your mortgage. You also can use that to actually bring down your income tax, right? But your income tax on rental, but after all this, actually is still not cheap. Okay. And then of course, there's also agent fees of at least 1 month rental. Each time the rent expires, you need to get an agent to actually remarket for you. And then there's agent fees. Okay, and then of course mortgage the mortgage interest, which is around we estimate the long-term average mortgage rates in Singapore will be around 2.4%. Okay, so all this added up will actually bring down your rental use as well as your investment return. So if you see an investment return that is 6% or rental yield at 4%, it's not true. You have to actually add up all this. When you add up all this already, the rates is much lesser. Okay, so don't be fooled. Right. So again, not to mention, you buy this type of rental property also, you still need to go and manage the different tenant profile. Okay, if you're lucky, you get a good tenant, then very easy to manage. Management should be very easy. Okay, but if you get a tenant from hell, you may find yourself spending a lot of time managing them because they don't pay rental, they spoil your things, they don't want to move. You have to go and break into your own house to bring them out, to evict them. Very troublesome. So a lot of times, definitely not worth it. Okay. So now, how about the returns for S-REITs? Okay, so I believe this one is more what you guys actually want to find out because I see that a lot of the stuff earlier on when I did a poll, a lot of you guys say you come here, you come here just to listen to maybe me talking about REITs itself. That's great. Okay, none of you actually more looking at buying actual condo property for investment, which is good. Okay, so now I'll share how about the returns for S-REITs itself. Do you think it's the same? Okay, as what I shared with you just now regarding the yield. Okay, so property we look at, of course, capital appreciation and yield only, these two only. All right, so now we also look at S-REITs. Okay, capital appreciation and yield. How do you perform? We use data to determine the returns. Okay, let's find out. Okay, for you, some of you guys who don't know, okay, what is a REIT? A REIT is a real estate investment trust that this type of trust actually owns, operates, and finances income-producing real estates across various sectors, allowing individual investors to buy shares in commercial property portfolios. Okay, REITs trade on stock exchanges, providing liquidity, professional management, and high dividends, usually by distributing at least 90% of taxable income to the shareholders. REITs in Singapore are considered an accessible alternative to brick and mortar real estate because they drastically lower the barrier to entry, offering lower capital requirements, higher liquidity, and passive management. While buying a physical property in Singapore, like I said, can cost $100,000, hundreds of thousands of dollars. Okay, REITs allow investors to gain exposure to professional property portfolios for just a few $100s. Investors for REITs don't have to pay taxes and ongoing fees. Therefore, what you earn is what you keep. Okay, so let me introduce you to this REIT that I'm going to actually share with you guys. This is the Lion Global Philip S-REIT Index ETF. Okay, this REIT tracks the performance of the largest and most liquid real estate investment trust listed in Singapore. Okay, now let's talk about the returns. I believe you guys already seen already when I was actually explaining to you guys about what REITs are. Okay, you can see that for the capital appreciation part, okay, REIT did not the overall REIT market in Singapore did not do very well. Okay, it is a total negative return of 24% to date. Okay, or 5-year annualized return. Okay, just now I share about annualized return for what? For condos. There was around annualized return from 3%, okay, all the way to 6%. Depends on where you buy the property, right? Okay, for the past 5 years. Taking the same measurement, okay, for the Lion Global for the past 5 years, again, you see, it's now negative 5%. So you bought that REIT, you've lost 24% to date. Okay, if you're bought at the peak. Okay, why the poor performance? Okay, for this Lion Global, I mean for all the major S-REITs in Singapore in terms of price. Okay, this is primarily due to the hostile macroeconomic environment characterized by rapid rising rates in the last few years, which has increased borrowing costs, and it is compressed the valuation spreads for the Singapore REITs So you must know that REITs actually rely a lot on the interest rates. It actually, why do I say so is because when you actually let's say you run the business of a REIT, okay, you need to borrow money, right? So because you borrow money to buy properties, buy all these stuff of commercial properties, as long as the rental, no, not the rental, sorry, as long as the cost to loan, the investment cost, I mean the borrowing cost, the borrowing cost stays low, okay, your rental yield, the REIT itself will actually get a very good margin on the rental, okay, because the yield they can actually get this much, but they pay only so much on borrowing costs. So that's why the margins they earn is very high. But when the borrowing cost actually goes up, okay, the interest rate comes up, borrowing cost goes up, okay, the yield only they can get so much. So of course the margin is lesser. Because the margin is lesser, you get, of course, when the REIT earns lesser, your distribution income also becomes lesser okay, or the dividends, they will lower the dividends. And of course, not only lower the dividends, the prices also come down. The valuation of their portfolio also drops, also declines. Okay, because investors tend to sell out when they know that margins is squeezed. Okay. So let's talk about the individual the performance of the portfolios of the REITs okay, for the various REITs in Singapore. So for office REITs they face a lot of headwinds from the work from home trends, of course, and hybrid work models impacting occupancy and rental growth. Okay, another very popular REITs in Singapore is also the logistic REITs. Okay, the industrial and logistic REITs. They still remain very resilient until today, but also experience some negative rental reversions in specific markets. Okay, because I said that the declining property valuations for commercial REITs in Singapore have come down is due to the interest rates currently. So a lot of people believe that most REITs now won't earn as much because of the current interest rate environment. Okay, but being said, okay, if you take a look at the Lion Philip S-REIT ETF, the good thing about it is the dividend yield is still very healthy at 5.28%. So it's 5%. Okay, as I mentioned earlier, this yield, this rental, this dividend yield is actually the net of what you get, because there's no further cost to actually pay for. I mean, you don't have to pay for any taxes or anything like that on dividends if you receive dividends in Singapore. Okay, so you might ask, based on the findings of my sharing so far, okay, which investment path is better? Buying an investment property in Singapore to rent out, or should you buy a good Singapore REIT? Okay, we look at again the two criteria. One is capital appreciation, the other one is rental yield. Okay, we compare them side by side. Okay, let's see. So for the capital appreciation segment, okay, between 2000 and 2026, an investment condo showed an average annualized gross return from 3 to 6%, depending on the location, while the Lion Global Philip S-REIT Index ETF showed a negative annualized return of negative 5% between 2021 to 2026. Of course, you compare both assets from the capital appreciation perspective. Owning a private condo for investment seems like a better option, because if you have bought a condo in 2021, you could have made a total of return of at least 24 to 48% in the last 5 years. While owning the S-REIT, you could only find yourself losing 25% from 2020 to 2026. Okay. How about the rental use segment? Okay, the rental use segment, if you compare it side by side, the projected gross rental yields of an investment condo range from 2 to 6% per annum, depending on the location again. Okay, while the Lion Global S-REIT Index ETF provided a current dividend yield of 5%. So comparing both assets in this case, from the yield perspective, now slightly seems more competitive, because owning a private condo offers a wider range of yield options. Okay, while the REIT gets you a dividend of at least 5%. Okay, this means if you invested in a condo situated at a poor rental location, poor demand location, because you need to go and find a condo, then you realize that, hey, this one, you just buy a wrong one, you could be looking at rental yield of 2%. This is gross. So after minusing all the costs, you will get less than 2%. Okay, while investing in a condo at a good location could yield you a 6% return gross. Okay, so if you get a good condo, this is like playing lottery lah. If you get a good condo, then you at a good price, okay, good for you lor. You get a better rental yield, and of course it also depends on the rental market of the economic cycle. Okay, so that's why in this sense, buying a REIT will be better, because the REIT is what you when you receive the dividend at 5%, this is what you get. Okay, there's no additional cost, and you don't have to go and hunt for a good, a good property or good REIT. The REIT does it for you lah. Okay, so what you get when you see 5% is 5%. But when you buy a condo, different because if you buy a poor one, a lousy condo, then you get a lower rental yield. Too bad for you. Okay, so in this sense, REIT is better lah. It offers a more security compared to buying actually a physical brick and mortar condo itself. Okay. So from this comparison, comparing both the capital appreciation and rental yield, okay, what would you choose? Okay, would you actually buy a investment condo or buy a REIT? Okay, if you let's say believe that after you see my slides, you realize that from the data, you think that condo is better, put a 1. If you think that a REIT is better, put a 2. Come, show me. Let me know. 2. Oh, still, Beng E still thinks that buying a REIT is better. Any more? Wow, all 2. Thanks, Gabriel. Thanks, Louis. Thanks, Henry. Okay, thanks, Wai. Wow. Okay, thanks, guys. Thanks, Shankar. Wow, everybody's choosing 2, despite the every time when I mentioned that the capital appreciation is also coming down, you still think that REIT is better, because REIT now is down, okay? So while condo is up, you all still think that getting a REIT is better. All right. Nice to know. Okay, let me continue. Let's dive deeper. Okay, to see if any of you change your mind later. Okay. Now let's look. Let's compare now with the pros and cons of investing in an investment condo versus a Singapore REIT. We'll drill down further on the potential capital appreciation and yield criteria again. Okay, we'll look at these 2 criteria and we compare the pros and cons from there. So from a capital appreciation perspective, what are the pros and cons if you were to compare owning an investment condo versus a REIT? Okay, so what are the pros of owning a condo? Okay, there's the perceived security as the condo is brick and mortar. Okay, and investor must have a long-term mindset and do not intend to flip it. Okay, banks offer decent leverage for brick and mortar properties of up to 75%, and loan rates are relatively cheap today. Okay, so if you like to actually compare this to a REIT, okay, I'd like to share with you guys. At least the bank can lend you $1 million to buy a condo at maybe an average of 2.5% interest rate. If you, let's say, you want to borrow from a bank, all right, you can never do that for a REIT. Okay, REIT, you cannot say I want to borrow $1 million and get and then I pay interest to a bank of 2.5%. All right, then you can earn you can earn the difference. That means the REIT pays 5%, then you just take a loan of 2.5%. Not possible. Okay, so this is the added advantage for buying a brick and mortar condominium or property. Okay, owning a good investment property using some leverage can of course provide an outsized return over time. Okay, the demand for private residential properties is set to continue, and we could see capital appreciation growth for residential properties in Singapore due to increased population growth. Okay, imagine one day Singapore will become like Hong Kong. So if you all guys didn't know, that's what I see from my own opinion. Hong Kong now property, if you take a look, most of the sizes are becoming smaller. I mean, already are very small. So if livable unit now people talk about only maybe a 500 square foot to 600 square foot. A whole family lives in it in Hong Kong, and it's not cheap. All right, Singapore, we are looking at the trend now. It's also going to be the same. Okay, new projects are now actually building smaller and smaller. HDB is also same. All right, but the good thing is actually HDBs, the government are more aware because the good thing about Singapore and of course versus Hong Kong is that in Singapore the government still uses they still provides the citizens with government housing. So in this sense, government housing is still cheaper, relatively cheaper compared to private properties. But I'm seeing going to that level of Hong Kong already. Maybe in the next 50, not won't be in our lifetime, but maybe in the next 50 years lah. So our children might feel maybe children or the grandchildren, okay, will feel the pinch. One day you'll be living in very small units for full family. Let's your kids okay, or your grandchildren when they start their families. By that time already, a condo can be maybe about $5 million, $6 million for a small unit, and a huge, maybe a family of 3 can afford this type of pricing. They will stay in this type of small unit condos, private condos. Okay, so that is why I feel that in Singapore now, okay, it's going to be towards the direction of Hong Kong because of the land scarcity. All right. So how about the pros for REIT? Okay, even though we saw that REITs have generated negative returns since 2021 from its peak, there could be some buying opportunities as prices have come down. Okay, owning multiple commercial properties do not incur ABSC, unlike private properties, and could provide good buying opportunity when markets soften. So the REIT itself can actually buy properties cheap when the market soften, which is a good thing. Okay, and when prices are now down for REITs, okay, it gives also the unit holder or the investor a good chance to actually enter at current pricing. Okay, if you bought the peak, then of course you won't, the risk is higher, of course. So buying at current prices now minimizes the risk already, and then also you can capture the capital appreciation in time to come. Okay, however, you must have conviction okay, that commercial real estate will eventually recover. All right, when it does recover, like I mentioned earlier, you actually gain the cost to benefits it will be stronger. Okay, so owning a REIT does not incur ongoing hidden costs as well, other than brokerage fees, and it's also more liquid. Therefore, returns are going to be much more cleaner than buying a condo itself. All right. So now let's take a look at the cons of owning a condo. So there are many hidden costs associated with maintaining a brick and mortar property. The costs such as taxes, monthly maintenance fees, and interest charges can lower your net returns. Owning a brick and mortar property is not liquid, and therefore there's a risk that you will need to lower your selling price below the market rate in order to sell it. Okay, if you need the funds urgently, then this could be a problem because When you need the funds urgently, you have to put the prices even lower, and then because you're forced to sell, and then this will affect your net returns. So it's very hard to actually predict your forecast, your true return from investing in a private property, okay, or condo. What you see, like, people, when you look at the property guru websites, oh, this person earned 500,000, this person earned 1 million, because the market is good, and then there are no rush to sell. But if you're in a rush to sell, you need the money at the time, I don't think your returns will be that ready. So don't believe property agents when they share with you, oh, your returns can get so much, so much, so much, so much, so faster buy now. Don't believe all this hype. Okay, it's not true, because when you need the money at the time, it's hard to sell. And you have to put your property out there for 1 year or 2 years because you need to sell at the right price. But you need the money, you need the money urgently. So this will affect your returns. Okay, so you risk buying a property that will also eventually become old, and because of a change in buying behavior, the value of your property eventually stagnates when new projects develop, thus lowering your potential returns. And then also there's a risk that you're unable to pay off your mortgage, and then you risk your property being foreclosed by the bank. So due to the over leverage. How about the cons of owning a REIT? Okay, because a REIT is a managed fund, there's also a risk that REIT managers do not manage the REIT properly and buy assets that are risky, thus lowering your returns. Aggressive REIT managers may also over leverage, making it risky, affecting returns when interest rates rise. Okay, there is a risk also that a highly leveraged REIT files for bankruptcy, and then in the end you lose all your capital invested. So these are also the risks of owning a REIT. So both has risks, investing condo and investing in REIT. Both has its own risk involved as well. So let us now take a look at it from the use perspective. What are the pros and cons? Okay, if we own an investment condo versus a REIT. So for investment condo, from a yield perspective, okay, you are able to receive rental on a monthly basis, and this could allow you as an owner to enjoy passive income monthly. Okay, and then because now it's more predictable, you can get your rentals every month. You can go and use the money for retirement, early retirement, and you also have control over the rental income because you can have the ability to increase your rentals. Okay, when demand is very strong. Okay, how about the pros of owning a REIT? From the yield perspective, you need not worry about managing the tenants, and the cost with running the operations is also non-existent because all is managed by the REIT manager itself. Okay, and the REIT manager also can optimize his operations so that the shareholders can receive sustainable dividend payouts. Okay, the yield for REITs is also net of all associated costs. Therefore, if a REIT provides a dividend yield of 5%, you get 5%. So that is the pros. And because there's no taxes or any other fees that you need to pay to get a dividend from a REIT. Now, let's look at the cons from owning a condo from a use perspective. Okay, the rental income on an investment property is taxed. Therefore, the yield you see in the real estate portals such as Property Guru, like I said earlier, is just gross. So in reality, you receive much lesser after taxes and other fees are paid. You have to also manage the tenancy on your own, and therefore there could be risk that the tenants damage your items, and they will miss your rent payments. So this risk lower your rental yield as well. And of course, you have to also pay the real estate agent fees that I mentioned earlier to search for a new tenant once the old tenant decides to terminate the rental contract. And this cost also has to be added into calculating your net rental yield. You also risk having your investment property not being rented out for many months because there's the rental demand may be soft at that point of time, and the loss of rental income affects your overall rental yield. Okay, while we look at the cons of the owning a REIT, okay, REIT distributions are paid quarterly. Sometimes, of course, some investors believe that pay monthly is better than a quarterly one, because monthly one you can see the money coming in every month, while quarterly one you need to wait 1 quarter only you can get the money. You can get your dividends. So some people prefer monthly. You cannot control the distribution payout as the REIT manager decides on the distributions, making it difficult to control your cash flows from the investment. Okay, so you will not know next year or the next quarter even how much the management is going to pay out. So this one will affect your decision making in terms of, like, let's say you want to use the money to do something or travel or retire. It's not very unpredictable. But of course, if you have your own property, you write out a contract with your tenant within the next 2 years fixed, you must pay this amount to me, something like that lah. All right. So this is the cons of in the rental use perspective for owning a REIT. Okay, there's also risk that the REIT manager halts distributions for indefinite period of time, and your income becomes disrupted. So, and you have no control over it. So in this case, when a REIT actually invests most of its assets overseas, and these assets actually house poor quality tenants, you might face this issue. So always look for a REIT that is reputable and does not have too much investments outside. So imagine if there's a REIT that actually invests in China. Okay, China at one point that last few years, they had a property bubble and the bubble burst. A lot of REITs actually invested in China got hit big time, and then they cannot manage to pay the dividends. So they halted dividends for a period of time. So you must be very careful when you invest in REITs as well. Okay, now let's take a look. Okay, from this perspective, after I shared the pros and cons, how many of you now think that still buying a condo is better or buying a REIT is better? Now that I actually put up side-to-side comparison of the pros and cons. So share with me, if you still think that it's condo, put 1. If you think that it's REIT, put 2. Okay, come show some participation, guys. Let me know that if anything has changed. Luis now got 1 already. Great. Thanks, Ranjan. Everybody still 2, good that Luis actually. Now Kima also thinks 1. Great. Grace also now thinks 1. Yes, Grace, correct. Different purposes. Wow, we also think it's 1 already. Okay, but Grace is right. Grace is right. So actually, different purposes. All right, I wanted to share this in the next slide. There's no right or wrong path. Okay, so as long as both paths lead to Rome. Okay, both has its own risk, and the key understanding here is that which path suits you more at your current stage of life. Okay, both paths, of course, need a good understanding of its respective markets before investing. All right, like for private properties as well, you must actually do a lot of research. Okay, you need to spend time on it. Okay, a lot of people actually don't have time to do all this. Of course, the risk is higher in private property because the cost is very high. Okay, so you and if you don't have time to do it, a lot of times you get maybe oversold or overhyped by a property agent, and then you go into a wrong property. Likewise, for REIT, okay, make sure you really understand what REIT you are buying first before going in. You go in at the wrong price, wrong time, okay, also will lead you to that negative return that you will get. Okay, so everything has its own framework. Investing in condo, of course, I'm not here to share any framework of investing in a condo because I'm not a property agent. Okay, there are many books out there or many property gurus out there that can maybe share with you how to actually study a framework to investing in private property itself. Okay, of course, it depends on your life cycle, your life stage, what you want. So if you really want to master investment condo because you're already retiring and you want to use the money to actually pump into a private property, okay, by all means, go and study it. Go for a course, make sure you study first which are the actual good gurus that actually teach you a right framework. Not all gurus are good also. Okay, likewise, for REITs, okay, there is also a framework, okay, to invest in the right REIT, all right, to study a REIT. Okay, so make sure you identify good people, good teachers to actually teach you the right framework, and not to be fooled, paying a lot of money and then you realize that this teacher is not so good. These things can be learned from the textbook sort of thing. So always get a guru or teacher that actually has the experience in guiding you through all these frameworks if you want to. So a lot of times it's actually about your determination to learn about the markets or any market, okay, whether it's in the property market or the S-REIT market, or any other stocks. Okay, having a right framework is important. Okay, I say it again. So once you have done your homework well, you just need to wait for an opportunity, okay, to get in. So once you get in at the right time, whichever path you choose, you should do well. You should do well over time. So in a nutshell, okay, let's look at for investment condo again. Okay, the capital required is very high. Okay, appreciation 3.7 to 6.8%. Net yield is about 1.5 to 4.5%. Okay, liquidity is very low. Okay, management, like I said, very high effort. The tax efficiency is is taxed very highly. That's why we call it very poor. Okay, Of course, there's good leverage. You can use this to leverage for buying private condo. For S-REITs, of course, capital required is very good. Okay, very low. And then the appreciation is 5%, -5%, sorry, -5%. Okay. And the net dividend yield is 5%, tax-free, high liquidity. Anytime you can buy, anytime you can sell. You don't have to manage it. Once you buy a good REIT, okay, tax efficiency is tax-free. If you sell also, you make profits, tax-free. You get dividends, tax-free. Okay, but again, there's no leverage. So that's the bad part of a REIT lah. Okay, for me, I still prefer investing in a REIT as it's less hassle to manage. So I choose number two. I'm a person that choose two. Despite the cons, I think that benefits of owning a REIT outweigh the cons lah. Why? I like REITs for the fact that both capital gains and distributions are not taxed. Okay, whatever I receive is whatever I get net of all costs. The key, of course, here is to invest in the right time and maximize the yields. So to invest in the right time, you need a framework. Okay, you need a proper framework to identify potential quality REITs selling at fair values and buy into them when the market cools. However, all right, for this REIT framework, I will share with you in my next seminar. So if you actually are interested, since I already shared with you today my topic about you need to do good homework. Okay, I myself I cannot share with you about the property market because I'm not a property agent. But however, I can share with you my own methods of actually identifying REITs. I've actually identified REITs, very good REITs, and they've made money for me, all right. And I've kept these REITs for very long periods of time. And over time, I've really, including dividends alone, I made quite a lot from it. Okay, so I will share with you this framework in my next webinar. So should you, okay, here I end already. Should you actually wish to actually find out more, okay, about my next webinar, do subscribe to our Telegram group. Okay, here's the QR code. Subscribe, scan it, and then subscribe to it. On top of that, for my today's webinar, also I will share with you the summary of all the research, I mean the data that I've done, okay, the pros and cons and all the summaries of all the side-by-side comparison of the returns. I'll share with you guys in the Telegram group as well. However, do note that I will not be publishing this webinar from start to end okay, to you guys. So it will be just snippets of my summary of the maybe more key features of what I think is important in the Telegram group so that you can maybe refer back in the future. But again, all right, do remember to join me in my next webinar where I think I will share with you this more interesting, because since I see you guys here are more interested in REITs okay, I'll share with you my framework that I use in my next webinar. This will be, I will update you guys again on the next one. All right, so stay tuned. And of course, please give a feedback so that I can actually improve myself in the upcoming webinars and what you'd like to actually hear from me in future webinars. Okay, with that, I will open my webinar to the ground. All right, and would like to hear your questions. I'll answer your questions one by one. Okay, so let's start. So if you got any other questions, please feel free, okay, to put up. Okay, let's take a look at the first question asked. Okay, let me see. I'll scroll down. Yeah, I'll try my best to answer all the questions. Let's see the first one. Carlo. Okay, what does Carlo says? Grace says, yes, okay, earlier on at 7:59, Grace did say not forgetting about asset absolutes. Wow, Grace, you're quite experienced in the property market. Not bad, not bad. If Grace, you're still here. Very good. Yeah, so Carlos says, if S-REITs are exposure to commercial real estate, we're not comparing the same market segment to residential properties we talked about earlier. Okay, it's true, Carlos. I've actually thought about it when I actually did put up this webinar. But what I'm changing, my purpose of this webinar is more like, I like to share with you guys when you got actually some funds, okay? Because my purpose here is to drive my audience towards retirement. So if you got spare cash, what should you do? Okay, should you actually take your spare cash to invest in a condo or invest in commercial properties? Yes, I know it's different. Okay, we cannot compare apple to apple because you have to compare buying a commercial property. All right, it's a very fair statement. Okay, Carlo, great question. You have to compare commercial property versus condo. But I believe many of us here, if you want to actually invest, so we won't take our money to actually invest in a commercial property physically. All right. Even though there is no ABSD in investing in commercial property as an individual, I'm not talking about REIT. There's no ABSD. It's much easier to actually invest in commercial property. But again, commercial property has now most of the lease life is actually 30 years only. So that's the issue here. So that's why I said I prefer buying a basket. You cannot buy a basket, man. So the best way is to go into REIT, or if you got funds, go into residential property. So that's my purpose of actually sharing this webinar with you guys. Even though I know it's not an apple for apple comparison, but based on what we compare the pros and cons, okay, then you can decide whether going into taking your spare cash to invest in a residential property or investing in a REIT is better. Okay. So thanks, Carlo, for the question. So can PR buy, okay, Shankar, can PR buy a second HDB unit? Cannot. Okay, PR can't even buy one PR cannot buy HDB. You need to have married. Two PR only can buy one HDB unit. You cannot buy two. Okay, the government does not allow you to buy two government property. Okay, you only can buy one government property. Okay, next one. Okay, let's see. Grace says S-REIT has management fees, so your yield 5% includes this. Yes, okay. S-REITs, of course, they have management fee, but the S-REITs management fee already will be included when they calculate their P&L. So when they calculated their P&L, what you see is what you get already. The 5% is already after they've actually calculated all the profit and loss, all their the management fees, all their salaries. So whatever is balanced remaining, 90% of it will be paid out to shareholders. So this 5% is already included, okay, in terms of the distribution. All right. So Beng Yi, the other problem when condo, like having wear and tear, like leakage. Yes, correct. So you see a lot of actually issues when you actually buy a condo. You still have to repair all this, So how are you going to get the money to repair? I believe even rental you cannot cover. But if you buy a REIT, you don't have all these issues. You won't need to actually go and ask take your 5% from your dividend, say, oh, pay back to the REIT to go and repair those things. No need. 5% is yours because the REIT already expense all this out already. 5% is what you get. Okay, so the main thing, Benny, is that when you invest, guys, okay, when you invest in a REIT, you cannot only just rely on the dividend yield itself, okay, you must also see the capital appreciation. Once, imagine you buy at the peak, all right, when you buy the REIT at the highest price, you lose money every year, and then you just get the dividend yield. You actually net off zero, you just zero sum game, all right. You get high dividends, so what? But you're actually losing money every year on the capital depreciation. So the key thing here is to buy at the correct time and buy at the correct REIT that appreciates over time. Okay, not all REITs are good. Okay, let's see next one. Okay, Carlo, again, for investment condo, during soft market condition, the property owner may not have control over pricing. May have to reduce rental price in order to secure tenant. That's correct. Yeah, that's correct. So that's why condo also not necessary you have control over the whole thing, man. Okay. Okay, so like you say, like you may reduce the rental prices. So yeah, that's true. That's true. Yeah, great insight, great input. Okay, Kenny Koa says that property needs high cash outlay. REIT doesn't. That's correct, lah. So that's why I always advise, if you say you're in a stage that you want to actually get into the Singapore property market, what's the best way to do? Go into REIT only. You don't ever have to think of buying. Like I said already, because earlier on I mentioned during the webinar that Singapore land is scarce. This will eventually drive rental prices up and property prices up. So you want to get into the property market, the easiest way to do is REIT. Okay, Carlo says, what are the key factors one should pay attention to when selecting REIT for investment? Okay, one thing, like I share with you, the most important key factor to actually selecting a REIT for investment, the first thing I look at okay, is the asset. Okay, where the property managers purchase their asset, the portfolio, okay, the portfolio of assets. So if a property manager actually invests mostly in Singapore, this REIT I will take a look at already. I will be focusing on this type of REIT. A REIT, they actually having like maybe 60% Singapore, 40% other country, or very high concentration in maybe US, China, Indonesia. All these REIT I stay away one. All right, this is very important because if you buy a REIT that you cannot understand the policies there, okay, the government policies there. Some of them like to buy, like some REITs, they invest into like those hospitality hospitals in Indonesia, for example, and then huge chunk of them are from these countries one. Okay, I will tend to be more, my signal will be up already. I'll be more focused, more aware of this type of REIT cannot touch. Okay, I'll look somewhere else already. And then I would like to add on also, okay, some of these REITs are also maybe blue chip REITs, like you can say Capital Land, okay, they are hospitality REITs. But you see, this Capital Land hospitality REIT invest a lot into places like Indonesia, China. This type I will stay away. No matter how branded the REIT is, I'll be worried. Okay, so that's why this is one of the criteria I take a look at. All right, of course, there are still other criteria how to select. There's an approach to select a good REIT. All right, in terms of like there's a valuation, the price, management. All this I will actually share with you guys in the next webinar that I will share, that will focus on. Okay. Thanks, David. Very interesting. Thank you so much. Thanks, Mavis. Thanks a lot. Okay, Carlo, yeah, thanks a lot. Okay, Grace, yes. You can't get yourself to spend 1 million on REITs. Yes, that's what I said. But you can spend 1 million on a property, right? So you see, that's the difference here. It's very scary. If you're like, I got $1 million, should I go into REIT? Cannot lah. So unfortunately also, if you, let's say, because all of us Singaporeans, unless you are very rich, okay, you can diversify very well. Okay, then by means buy REIT and buy a condo. That'll be the best. They can get exposure to both. But unfortunately, not all of us can. So that's why I say I myself, I prefer to actually buy a REIT because it's so easy, so much easier to manage. Okay, Luis. Hello, I usually look if the NAV or unit has been going up or down. If down, it means the manager is destroying value. So I pass. If up, then I start looking at other things like the price to book or dividend yield. Thanks, Luis. Yeah, that's a great one. So you look at the NAV per unit. Yeah, but again, the NAV per unit most of the time is very close by to the REIT price. Okay, so of course there are some overvalued ones. It's a good one actually. I rarely use this. Okay, but Luis, you also can use this to. It's part of the toolbox. Okay, that you use to actually identify a good REIT. So one of it is the NAV. Yep, and the price to book. That's a great one. David, with interest rate, what is your long-term view of REITs? Okay, for my long-term view of REITs, I think for the Singapore market, the next 1 or 2 years, I think will not be good. Okay, if I were to actually give you upfront here, 1 or 2 years, I think REITs will continue to actually stagnate or come down some more. Okay, why? Is because it's not only the interest rate. All right, I believe it's also the view that rental prices have come out quite a bit. Okay, it's going to be very expensive actually renting a space in Singapore for commercial purposes. Data center is coming up. Okay, I'll share this in my next webinar as well. When I focus on the REIT framework, okay, my own REIT framework. Data centers is a REIT that I personally like a lot. But however, if you all guys know, okay, Johor Bahru or JB, it's going to be an economic free zone when the RTS comes out, or the rail, the rail system connecting Singapore to Malaysia. This will eventually bring most of the businesses from Singapore to Malaysia. Okay, because Malaysia is still much cheaper in terms there's so much land there. So by doing so, they will actually drive all the businesses there to actually rent spaces. So what happens to Singapore's, commercial properties? It'll be left empty, and then rents may come down. That's what I'm worried about now. Okay. Can you compare unit trust and REITs? That's a great one. Unit trust and REITs is a bit different. Okay, unit trust. This is by Grace. Okay, sorry. Unit trust is unlisted. Okay, while REITs is actually listed on the exchange. So of course, if you ask me to compare and which I prefer, I will prefer, of course, the one that is actually listed on the exchange, because you can actually easily buy and sell. Okay, it's transparent, but for unit trust, you know what the price is of that as of that day. So I believe a REIT will have the pricing more transparent compared to a unit trust. Unit trust, you sometimes cannot identify the price. So then you do not know how much the unit trust manager charges, and it's not so efficient, I would say lah. Okay, so REIT is definitely better. So Beng Yi, for long term for property investment, I cannot really understand what you mean, Beng Yi. For long term for property investment. Okay, so Grace says property is more stable with uptrending capital appreciation, and it is a physical asset. Yeah, of course, that's correct. It's a physical asset, and then because it's depends on what property. Like I said, okay, if let's say you're talking about commercial property, not true. Commercial property, because got the lease life is very low. It's not 99 years. So of course, commercial property will depreciate faster. Okay. Residential properties like condos like that, 99 years, also will depreciate. But of course, you can pass on to your children and can stay, ma. Okay. Commercial property cannot stay. Okay, you only can rent to businesses. Okay, Kalok, yeah. Thank you, Kalok. Okay, hope you can join my next webinar. Okay, Beng Yi, for liquidity and dividend, go for good REIT like Singapore Land. Oh, okay. Let me go study Singapore Land as well. Maybe I'll bring it up in my next webinar. So Beng Yi, come to my next webinar. Maybe you can discuss about Singapore Land. I will share with, hopefully I can share with the audience as well. Singapore Land. Great one. Okay, Grace. Okay, so I'm putting more funds into REITs. Thank you, Grace. Okay, Kenny, due to AI, REITs focus on data centers. Yes, Kenny, you got it. I want to talk about. Actually, I'm very compared to all the REITs now in Singapore. Okay, actually, data centers is the one that I'm actually is more promising. All right, but of course, there's still risks involved, because, like I said, the Malaysia is actually a competitor in this area of data center. But of course, I said again, REITs also can buy into Malaysia one. Okay, the Singapore REITs, they also can invest a portfolio, can take up a portfolio in Malaysia as well. So we can also explore that in the next webinar. All right, thanks, Louis. Okay, see you again. Okay, Grace, data center are great device. Yes, correct. So that's why actually Malaysia. Oh, Grace can have two Graces. Okay, so yeah, Malaysia, the electricity prices, the energy prices there are cheaper also. So that's why there's a risk also. Okay. Where a lot of REITs here a lot of data center REITs here will move to Malaysia, will move their operations to Malaysia, because energy is not sufficient in Singapore. Okay, it's getting more and more expensive to run data centers in Singapore. That's why now most of the big techs are actually moving into Malaysia. And the Malaysian government is actually actively inviting big techs into Malaysia as well. So Malaysia has a huge opportunity for this. All right. Hope I've actually answered all the questions. I hope that you guys actually enjoyed the webinar, and do come to my next one. Okay. So please subscribe to the Telegram channel and also fill out the feedback form. All right. If there are no more questions, I shall see you in my next webinar. All right. Stay tuned. When you go into my Telegram, you will find updates on my next webinar. Thank you, Grace. Thank you so much. All right. See you guys. Okay. Goodbye. Bye, everyone.